Hey, what's up, guys? Fidel here. I hope you're all doing well. So, it has been a while since I uploaded on this channel, but of course, you are aware that we had a child, and as the law requires, we had to go through certain registrations and we had to go through the immigration, which takes long. And of course, we are new parents, we are still very young, and this is our first child. We were so confounded by the changes of having a child. We're talking about sleepless nights and so many other stuff. Kudos to you guys that have kids, mothers, fathers. It's such a blessing. So, previously, we spoke about the three simple steps to a trade setup, which was part one. I gave you a few examples and I thought I should release a part two and we continue from there. And of course, like I mentioned on my Twitter, I'm planning to stop uploading videos. It's so much, it takes so much time and I have other commitments. So instead of uploading videos, I'm planning to um, go live with you guys at a private group when whoever is available. I ask you to send me your questions and then I schedule a live session with you guys and answer your questions. It's not a mentorship and I won't be charging anybody. And so it's not a mentorship. It's basically having time with you guys. And if I'm able to help one or two guys out of you guys, it it's a good thing that you were able to to help a few individuals in their trading career. So it's gonna be free. And yeah, so that's basically the plan. So the three steps to a trade setup. So like I mentioned, the first thing is to have a POI. In other ways, you need to have a PDRA. When you come to the smart money community, we call it a PDRA. Others will call it a point of interest or POI, an important area, a important zone. Whichever you can call it, the term doesn't matter. What matters is to understand what it represents and how to utilize it. So the first thing to a trade setup is to have a PDRA that you can continuously execute on it, right? You have to pick one PDRA, focus on that PDRA, execute on it continuously, master it in such a way that when you come to the charts, the only thing your eyes will see is your PDRA. Everything else becomes noise to you, right? So, for instance, me, I focus on liquidity and market structure. If you've been through my videos, you would know already that I trade liquidity and market structure. If I don't see liquidity, I am not interested. If I don't see a market structure, I'm not interested. I have roughly about 6 levels of market structure that I understand, that I use, and um, you don't need to know all of that, but you need to have a PDRA, and market structure is extremely important. Why is it important? Because without market structure, you will never know which liquidity is going to be taken first. People say market structure is not needed. What's important is a run on stops. Yes, a run on stops, but let me ask you something. If you are here we have these run-on stops. Okay, we have these run-on stops right here. How do you know? Because this candle that is going bearish can at any point start going retracing and become bullish. It can close bearish, the next candle continues going up. So how do you know that this is a confirmed grab of liquidity? How do you know? Because when we go in here, you will see that we had a confirmation in form of market structure. If you watched one of my videos where I said that liquidity is like a ladder, I mean, the market structure is like a ladder. Liquidity is what runs the market. So the market, runs on liquidity. It hunts for liquidity. However, since we have buy side and sell side liquidity, you will never know which liquidity is to be taken first unless you had a structure that is showing you which liquidity to be taken. So structure is a ladder by which the market climbs on to attack a liquidity level. When we price fails to take up this high, right? When price fails to take out this high, and then instead we take a low and we take another low. What is that signifying? It means market structure is telling us, hey, price is not ready to attack this high, this liquidity. We could be attacking a sell side liquidity, and then my eyes turn to the sell side, which liquidity is market structure showing me, because market structure is showing me that this liquidity is not ready to be taken. So therefore I have to look for the sell side liquidity, because structure is showing me that this buy side won't be taken anytime soon. But because you are focusing on liquidity, that when price makes a high, then it will make a low and then high, and then we have to grab this. By the way, when we are bullish, this is not a buy side liquidity. This is basically price taking a high to form another higher high. A grab of liquidity is always when price makes a reversal. There is no grab of liquidity without a reversal. However, there is what we call mitigation. There is mitigation, there is rebalancing. When there is an imbalance in the market, and there is rebalancing, and then there is immediate rebalancing. All these terms, of course, it's important to understand what they mean. That's something I can explain later, okay? But every time we have a grab of liquidity, we anticipate a reversal. If you watch the videos by ICT, every time he was teaching about a liquidity grab, always it has to be followed by a reversal, right? So now, since market structure is showing me bearish, what is the next structure that price is going to attack? The next low. We have this, we attack it. Okay, so Fidel, we've taken sell side, so we should reverse. No, why? Because structure is not showing us a reversal. The only time we would think about reversal is price taking this low, comes back and takes this previous high. And then we would expect a reversal. So now, since price has not shown me a structure for reversal, my focus shifts to the next pool of liquidity, which is this one. You understand? And that's why liquidity and structure moves together, hand in hand. They work together. There is no liquidity without structure, because there is a way the market is structured to operate. Everything operates under certain laws. Even human beings, they operate under certain laws. If A happens, I need to do B. If B happens, I need to go back to A. That is the way, that's the sequence. I don't know if you're getting my point. I'm asking you as if this is a life mentorship. Crazy stuff, right? So there has to be a grab of liquidity. There has to be a structure. But the grab of liquidity is my personal PD array. You can choose. I gave you examples in part one. There is a return to the origin. The return to the origin is an OTE, which is, for example, a return to origin. It's, for example, when price broke this low and then price goes back to where it started from and then falls. You can focus on that. Another example would be like this, but I'll give you examples shortly. And then we have breakers, we have order blocks, we have liquidity, imbalance. There's so many PDRs. We have supply and demand, support and resistance. Oh, did you mention support and resistance? Of course, I have to mention, because there are people who are making money with support and resistance. In my own experience, guys, any strategy works. All the strategies, they work. The problem is the executor. You that is executing that strategy. That's where the problem is. And any strategy coupled with market structure works. Period. You see that? So now, I want to show you a few examples of. Now, let's say, for instance, let's start from here. Yesterday, this is London. London opens on this candle. This is DAX. I'm looking for a liquidity grab. Price takes this high. That's a liquidity grab. Why is it a liquidity grab? Let's switch to a lower time frame, M5. So the previous structure was this one. So I'm looking for this structure to be taken for me to confirm that we are going bearish, right? That price is not continuing going up. So let's go to a much lower time frame, M2. And this is where, okay. So now, if price is bullish, the higher time frame we are bullish. Now, if price is bullish, I expect price to respect this previous structure. It should not go below this previous structure. Okay, so price comes down, because I need to confirm that this is actually a grab of liquidity and not price making a high. But I have a problem. If price is making high, this from this high to this new high is not compared to as this previous swing. So if price was to make a high, it should, pay attention here, pay attention, it should make at least a 50% of the previous structure. Now I'm teaching you a bit advanced stuff. Meaning, if there was a shift in a break in structure, I should expect price to be here at 50%, at least at the equilibrium, or up to 100% before you can retrace. So the first sign that we have actually run on stops is this, because this is what do you call it? Not a Judas swing. It's what do you call it? There are so many terms, guys. Sometimes I forget all these terms, but what is that? There is Judas swing and Yeah, this is a tater soup. This is a tater soup. Okay. Now, still on the M2, I noticed something else. Before plies came into the structure, we created another structure here. Now, if you watch my old videos, I talked about something I call opposing structures. It's when you have a bullish structure and when price is supposed to come to mitigate here and continue, it creates a bearish structure. So now we have a bullish structure versus a bearish structure, and these two are opposing each other, and therefore you ask yourself, which one is price going to respect? Opposing structures, because you have a bullish one and a bearish one. Now, in my own case, when I see this, I wait for price to show me what they want to do. And then something else happens. I was expecting price to break this high and then I buy. But look what happens. We didn't break it. We actually we offered a theta soup or a grab of liquidity. So many SMC traders, they use this as a breaking structure. That's okay, but when you come to SMB, we do not call this as a breaking structure. This is a theta soup or a grab of liquidity. Then this is still protected. Then this guy, we had this low, fails to take out this low, and then we respect this candle, which happens to be the order blow. Okay, I'm still waiting. And then finally, we make another low. Forget about this wick. If you remove the wick, this is a swing low. Even if the wick is still there, we have candles that closed below this candle. So this is a low. Then price returns to this order block, which happens to be offering a fair value gap. So on this candle right here is where I made my entry, because now the failure to go higher, instead we grab of liquidity and make a low, confirmed to me that this structure is about to be disrespected. So I entered here, stop loss here, and then we sold. And then something else happens. When New York, was this New York? Yeah, New York opened here. Not at the 9:30, it's the 8:30, I think. Price left this imbalance in here. New York comes, grabs it. After grabbing that, we had a grab of liquidity. We have this breaker because price went below it. Here, another entry. We go down. Now here is a structure returning into the previous structure for mitigation. A low, a high, a low. We come back in here. We have some of you that trade off fair value gaps. Here is a fair value gap. We can see if it's above 50%, yes. So equilibrium, you can take it, and we go down. So I've used a fair value gap, a breaker, a grab of, excuse me guys, excuse me, I'm so sorry. And then a grab of liquidity. And today we have a grab of liquidity, previous day's low and an odd low been taken. This is a previous high, price breaks it, comes back into it. These series of candles are breakers, and then price goes up. Anyways, guys, I'm running out of minutes, as you can see right here, but I hope you understand how you can utilize these steps to find a trade setup. Until next time, stay blessed.